The claim that the Trump administration might impose country-specific U.S. tariffs on 1 kilogram gold bars instantly altered market price behavior and disrupted trade flows within seconds. Almost immediately, as U.S. gold futures hit new highs, spot market trades lagged, causing the spread between the two to widen sharply. The rumor gained particular traction with talk of a potential 39% tariff rate for Switzerland, and the futures spot spread in U.S. dollars surged toward 100 on trading screens that day. Refiners and logistics companies quickly adopted a wait-and-see stance, while shipping teams suspended flight plans due to unclear U.S. customs classification language, and the market reacted in kind. The core question became, which gold bars would fall under which tariff classification? Without clarification from Washington, the trade chain stalled. Initial panic gradually shifted toward a partial stabilization, but the market still awaits a written framework clarifying the effective date, scope, and possible exceptions, closely watching the timeline for an official U.S. statement. The reason for such a dramatic price swing in such a short time lies in gold's dual role as a critical collateral asset and as a commodity that can create immediate stress on trade logistics. As doubts grew over the trade route of physical gold bars meant for U.S. contracts, the futures spot gap widened further, dampening the risk appetite of market arbitrageurs. If a certain class of bar unexpectedly fell under U.S. tariffs, delivery timelines for forward contracts would have to be postponed. In that case, arbitrage players would have to recalculate the buy-transport-deliver equation, factoring in the U.S. risk premium. While this mechanism may appear simple, it disrupts market equilibrium by adding sudden extra costs and delays. In short, the futures spot spread widens when a logistics bottleneck forms on the U.S. side, especially when storage, insurance, and flight risks add to trading costs. Prices shift not only because of demand, but also due to uncertainty in tariff language. The panic usually subsides not through emotion but through clear procedural steps. What looked like a simple bar tax quickly became a confidence test for the U.S. financial system. On the refinery side, the immediate impact was seen in halted shipments and postponed trade flights, pending clarity on customs interpretation. While jewelry retailers adjusted their display prices in line with U.S. retail trends, manufacturers relying on gold alloys and components took a far more cautious stance. Electronics producers, who use gold for plating and connectors, began monitoring lead times and exploring alternative suppliers in case of United States delays. But even with alternatives, if tariffs apply to another country, the market will still be consumed by questions of origin, classification, and product codes. This is where United States-specific delivery certificate language becomes crucial, as carriers, warehouses, and insurers won't move until they have it in writing. Switzerland's diplomatic response can also be read through the trade lens, given gold's central place in its precious metals industry. If Washington enforces high country-based tariffs, negotiations over exemptions between Bern and D.C. are inevitable, and delivery delays are expected. Such delays will influence preferences between major financial hubs, with the market seeking new trade bridges in the London-New York-Zurich triangle. Even technical terms like good delivery matter here, because United States contracts depend on these standards. Producers and traders are forced to examine fine details like product codes and casting methods, details that ultimately dictate market speed. In this case, diplomacy is more than symbolic, because a single sentence change in United States tariff rules can lead to significant cost differences. So, the most cost-effective move for authorities would really be to remove uncertainty with a clear, written, and simultaneous statement. From a consumer perspective, the impact will be, well, layered. In the short term, United States jewelers will tweak price tags according to market momentum. In the medium term, inventory costs, plus taxes, may squeeze profit margins. Electronics producers, even though gold is a small part of their costs, may still see disruptions if United States deliveries slow down. If such issues persist, the market could face a second round of price hikes. If credit conditions tighten, United States consumers become more price-sensitive, deferring purchases. Over time, if delays become permanent, retail sales would dip and market confidence would erode. So why focus on the 1 kilo bar? Well, in trade language, it's actually the most common, liquid, and standardized unit, making it really easy to deliver and arbitrage. If it falls under tariffs, the fastest moving trade unit suddenly becomes a choke point and prices rise accordingly. That rise reflects not just the added cost, but also lost time, which, limits flexibility. And when flexibility drops, alternative routes are explored. But those come at higher costs for shipping, storage, security, and insurance. These higher costs, they trigger new negotiations between jewelers and producers over who's going to absorb the burden. Such negotiations often get recorded in the fine print of contracts, which helps to ease tensions a bit. In the end, when the White House signals it will clarify the rules, panic eases, but the written text remains essential for confidence. If an official order clearly states which bar, which origin, and which rate applies, the future spot spread narrows and United States delivery chains stabilize. But without clarity, the no planes costly insurance full warehouses cycle just becomes part of trade costs. While, the likelihood of reversing tariffs may be low, mechanisms like excess tariff refunds could actually soften market impacts. Without such measures, the divide between jewelers and investors will just keep widening, and gold trade will gain a reputation for being both expensive and, complex, which could really further suppress middle-class spending and shrink trade volumes. Switzerland's weight in the refinery logistics finance triangle has always made its gold trade relationship with the United States, pretty sensitive. Even a single-sentence decision can spark weeks of debate and honestly alter the tone of the market. Quick agreement on the scope, duration, and exceptions in writing would restore normal trade flows and cut costs. Otherwise, sourcing from other centers will rise, bringing new origin risk into play. If origin risk increases, United States contracts will demand more collateral, forcing players to set aside extra cash, which, pulls funds from other sectors and triggers a chain slowdown across the economy. That slowdown can reduce investment appetite even outside the precious metals sector. From an investor's standpoint, the smart move is to follow procedure over sentiment, a principle deeply embedded in trading discipline. For jewelers, this means avoiding overstock during volatile periods. For fund managers, tightening collateral controls. For refiners and logistics players, a wait-and-see approach can contain costs and lower market tension. Retail investors should remember that local gold premiums may remain volatile for a while, so tracking the price spread time trio is essential. The fastest fix for this is a clear Washington statement, which could instantly normalize flows once it spells out product and origin specifics. Zooming out, the public's main expectation is a well-defined framework. The moment country-based tariffs are mentioned for a global product like gold, the market splits between futures and spot, and trade logistics get disrupted. If clarification comes swiftly, panic fades and plans adjust. Without it, volatility lingers and U.S. consumers bear more of the cost. If it is put in writing, all sides, jewelers, electronics manufacturers, refiners, can breathe easier, and trade returns to normal, closing an unnecessary inflation channel in the United States economy. So will Washington close the uncertainty gap with a quick fix, or keep the debate alive longer? The agenda moves fast, and trade headlines can escalate quickly. Here, we aim to break down these issues in clear, simple economic language, showing exactly how they hit the market. If you have thoughts from a United States trade perspective, share them below. It makes the discussion sharper and the analysis stronger. And to keep up with future updates, subscribe and turn on notifications, so when the Washington statement drops, we can review the details together and assess the market impact in real time. Thank you for watching. In our next video, we'll look at the effect of United States tariffs on non-gold metals and compare how their trade chains differ. The pace is fast, so let's stay calm, stick to the facts, and read the market with data.